Investors, welcome to Stock AI Insights. This is earnings analysis, and I'm your AI analyst, here to decode the numbers that matter.
Now, a quick reminder, this content is for educational purposes only and does not constitute investment advice. Of course, investing always involves risk. All right, with that, let's jump right in. Today, we are breaking down Cisco's pivotal first quarter fiscal year 2026 earnings, which were released on November 12, 2025.
So Cisco really kicked off its fiscal year with a bang, posting a total revenue of $14.9 billion. Now that's an impressive 8% jump year over year, but here's the kicker. It actually came in above the high end of their own forecast. That's a huge signal that demand for their products is seriously strong right now.
You can feel that confidence from the top. Chair and CEO Chuck Robbins said, "We had a strong start to fiscal 2026. Cisco is on track to deliver our strongest year yet." That is a bold statement. So the big question is, what's giving them this much confidence? Let's dig into the numbers.
Okay, first up, let's break down that top-line revenue. The big story here, without a doubt, is all about AI momentum.
And this is where things get really interesting. Take a look at this chart with me. You can see that the overall 8% growth isn't exactly spread out evenly. The real powerhouse, the growth engine here, is their networking segment, which just surged an incredible 15%. Meanwhile, you can see that security and collaboration were actually down. This tells a really clear story about where Cisco's success is coming from.
And that success has a name: AI. In this quarter alone, Cisco booked a staggering $1.3 billion in AI infrastructure orders just from their hyperscaler customers. We're talking about the absolute giants of the cloud: Amazon, Google, Microsoft. This is a massive acceleration, and it's the main driver behind that 15% leap in networking.
So, what's the big picture takeaway from all this? Well, the analyst consensus is that Cisco is positioning itself to lay the foundational railroad tracks for the entire AI economy. Think about it like this. They're not necessarily building the AI models themselves, but they're providing the absolutely critical, non-negotiable plumbing, the switches and routers that all that AI data has to travel through. But the growth story isn't just about those cloud giants. There are other powerful forces at play. We're in the middle of a massive, multi-billion-dollar campus refresh cycle. That's just a fancy way of saying large companies are upgrading their office networks, getting them ready for their own AI applications. On top of all that, product orders are up 13% across the board, with a huge 45% surge from service providers. The demand for modern networking is definitely broad, and it's picking up speed.
A powerful revenue rocket is fantastic, but you've got to have a solid cash engine to back it up. So let's pivot to our second section, profit analysis. And the story here is really all about margin discipline.
Cisco delivered non-GAAP earnings per share of exactly $1. That's a solid 10% increase from last year. And here's the key insight. Their profits grew at 10%, which is faster than their 8% revenue growth. That's a classic sign of a company running very, very efficiently. Analysts call it strong operating leverage.
And the company is turning that efficiency directly into value for shareholders. Just look at this chart. In Q1, Cisco returned $3.6 billion to shareholders through a mix of buybacks and dividends. But here's the really stunning part. That number represents 125% of their free cash flow for the quarter. In other words, they returned more cash than they actually generated, which sends an incredibly strong signal of confidence to the market.
The CFO, Mark Patterson, really summed it up perfectly. He said, "We delivered a strong quarter with top and bottom line performance exceeding our guidance, as well as solid margins and operating cash flow." It just reinforces this whole theme of solid execution and financial discipline.
From an analyst point of view, the number that really popped off the page was the non-GAAP operating margin of 34.4%. Beating the high end of your own forecast is tough. It shows that they're being incredibly disciplined with their spending, even while pouring tons of money into high-growth areas like AI. It's a really delicate balancing act, and it looks like they are navigating it just about perfectly.
All right, so a stellar quarter is one thing, but what about the road ahead? Let's move into our final section, guidance analysis, to see what management is forecasting for the future.
This table lays out their official forecast. So for next quarter, they're expecting revenue to be as high as $15.2 billion. But the bigger story is for the full fiscal year. They've raised their guidance across the board. They're now projecting up to $61 billion in revenue and over $4 in earnings per share. The message here is pretty clear. They expect this momentum to keep going.
So how should we look at this guidance? Well, analysts see a pretty balanced picture.
On one hand, the bull case is really compelling. You've got about $3 billion in AI revenue expected this year, plus that powerful campus refresh cycle. But on the other hand, the bear case points to some real risks. The shaky macroeconomy could slow things down, and that weakness in security is a real concern. Plus, their huge acquisition, Splunk, is shifting to a cloud subscription model. That's great for the long run, but it can mess with how revenue gets reported in the short term, creating a bit of a headwind.
So, what's our final verdict? Cisco's strong quarter is being fueled by the twin engines of massive AI demand and that big campus refresh cycle. This really positions the company well for future growth, even though they're facing clear headwinds in some of their other segments like security and collaboration.
Analysis verdict: Cisco's strong quarter is fueled by significant AI demand and a campus refresh cycle, positioning it well for future growth despite headwinds in specific segments. Drop a 1 in the comments. See you in the next earnings breakdown.